All right, everybody. Good morning, afternoon, evening. Welcome to the 80/20 Rockstars podcast, episode 5. Today we've got Paul Clough with Fresnel Partners on. Welcome, Paul.
Good morning, Rodney. Good to see you, and good to be here with your group.
Thanks. And I'm actually excited to have this conversation. It's one of the few times I feel like we're talking where you're not calling me. I'm like, oh God, what am I missing? So, for everybody watching, Paul Clough, he's your partners with Dan, right? With Fresnel Partners.
Yes, there's two of us that own Fresnel Partners, and then we've got a team of people who do accounting and bookkeeping work, and a small staff here in the office.
Awesome. So you handle pretty much accounting, tax planning, like compliance. You do some management and advisory services, and this. I don't know if it's mostly real estate, but is most of your business real estate, or you kind of cover like all industries?
The accounting and tax piece has evolved to where it is a lot of real estate. It probably over half now is real estate.
Awesome.
People who own properties, people who are agents and brokers and offices and title companies and a lot of things surrounding the real estate market. And while we're centered here in the Philadelphia area, we do have some people that are out in other states as well.
Awesome. Is there a lot of like differences with? Oh, I guess it's all pretty much the high level of the concepts are the same, but like between states, are there a lot of different tax laws, or is it pretty much the same across the board?
But actually, that's a great point that you bring up. Pennsylvania is sort of unique. Most states they start with what the federal law is, and then you take your gross income and without getting too complicated too fast, your gross income is kind of, if you've got losses or capital losses, those things get netted against your income. Pennsylvania has 7 classes of income, and one of those is real estate. Another one is investment income. Another one is wages. Another one is business income. And everything, you add it all together, and if there are areas like one of those categories has a loss, it doesn't do you any good. And with the federal, if you have a loss and you can't take it this year, it carries forward. That's not true with Pennsylvania. And so Pennsylvania, then, most states apply a graduated scale. So the more you make, the higher your tax rate is. Pennsylvania is a flat tax, and it's 3%. So Pennsylvania is kind of a unique state.
Interesting. I'm definitely going to come back to that later, especially what you just said about the classes of income, because that's something I learned during my when we did the tax return last year. But before we get into that, if you can tell me a little bit, I know you've been running Fresnel Partners, I think, for about 12 years now, right? Yep. I'm curious to hear just about previous life, because I've only known you for the past probably 4 or 5 years.
Right.
Like where you grew up, how you got into. I know you studied a couple of different things, and and you ran several different types. You were in different types of industries before accounting.
Right.
So can you tell me a little bit about
Grew up in Long Island, and all the way through high school. Went to college and got an undergrad accounting degree, and then moved back to New York and worked for what was then now would be a Big Four, large public accounting firm, and did audit work for 2 years. Loved living in New York City. Great time of your life to live in the city when all of your income is disposable, when you're young and have no responsibility. And then I a couple of things happened. I decided to go back and get an MBA, and left the accounting field, went back, got an MBA, and then moved back to New Jersey and lived in New Jersey for 3.5 years, worked for a large manufacturing company, and did financial analysis and business planning, treasury work, things like foreign exchange and stuff like that, all kinds of interesting things. And then I moved to this area. I moved to Yardley, and we've lived in Yardley since, and it's over 30 years now. Worked in the cable TV industry, where I was in marketing roles and started up a business called, actually was one of the founders of an entity that's still in existence today called Music Choice. And did some marketing with them, started a business unit to sell our music service to businesses, and spent probably a total of about 10 or 12 years in that industry and doing that type of work. And then I spent about 10 years in the call center business, mostly in marketing and strategic planning roles, looking at, and part of that was looking at companies for us to buy, doing the financial analysis on those companies, the strategic analysis, figuring out if it made sense to buy. And then I at the end of that, I left and went to another company, and it just wasn't a good fit. And I wanted to go do something different. And having done the accounting and tax work, having done marketing and operations work, that was more useful to small businesses. So that I went out on my own for a couple of years and was doing that. And then Dan, my partner, and I were referring clients back and forth and helping each other out, and decided just to put our businesses together. And that's when we formed Fresnel Partners. And so we've done a combination of business advisory work and then tax and accounting work. And when you ask about real estate was a small part of our business initially, and it has just grown and grown and grown and grown. And I guess by getting into the industry and people refer you to their, it's an industry where there's a lot of people that talk to each other and are involved with each other, and people are looking for help. And we've been able to do that successfully here in Bucks County, in Montgomery County, in Philadelphia. Really centered in southeastern Pennsylvania.
Yeah, there's a ton of word of mouth. It sounds like it was a pretty natural evolution, because you've seen so many different pieces of like business and management just from everything you just said. And I remember, I think the first time I met you was like just at our Keller Williams office, like at one of the classes that you just did about qualified entities. It's like, oh, if you make over a certain amount of money every year, you can actually like make an LLC and then pay yourself a salary and take distributions, and that could save you $5,000-$10,000 a year on taxes. Like, there's not a lot of people who are out teaching that kind of stuff. So I think if I'm imagining you've been doing that for a while, and I think that word of mouth spreads really fast, because I'm definitely giving your name to a lot of different people.
It is, and Keller Williams has sort of a focus on education, and so we've done some seminars both on the qualified association, but we've done things on how to keep track of your accounting and stuff like that, because they're always looking to educate the agents, and we're willing to come in and spend an hour and do that. And that, it was one of those where I met you, but a lot of our clients have come out of that. And you might meet somebody one day, and I had somebody come in the other day, and she'd seen me 2 or 3 years ago, and just was, her situation had changed, and so she wanted to talk about that. That was just yesterday.
Right. So accounting to me is like probably the most, or one of the most like unappealing parts of the business for most people, because no matter for most business owners and especially real estate people and investors and realtors, like everybody loves for the most part enjoys the business they're in. And then it's always like at the end of the year, or really it could be April 13th at like 11 p.m. They're like, oh my God, I got to put all this stuff together. I got to do my tax return. I don't think people give it like enough credit. And us in particular, like we haven't run things the most efficiently over the past couple of years. So like, why do you think, and maybe there's just an assumption, but like, why do you think most people don't, I think that most people don't give enough time to doing their accounting work, or don't maybe give enough importance that like you really need to keeping track of your numbers, however simple of a system you have, and like having a decent accountant on your side who knows what you're trying to do and can try and help you figure out your plan and save you as much money as possible on the way there. Like, I feel like a lot of people don't think like that. I do these days, now that we have we have these properties and all that, and I could see the difference of like, oh my God, we really have to plan what we're going to hold and sell and what gains and losses we're planning. But like, do you think that, why do you think that most people or a lot of people maybe don't give as much importance to that? It's kind of like an afterthought almost. Do you feel that way or?
Oh yeah. And I think it just doesn't come naturally to people to track it. And then
Mhm.
when you haven't done that through the year, it's like an overwhelming pile of work that you don't really like
Terrible.
doing, and you just put it off. And
Yeah.
and so it's sort of a natural thing for people to avoid doing things that's not the fun. Look, every job's got fun parts, and including mine
Mhm.
that I really enjoy doing. And then there are things that are not as much fun. And sometimes you just have to sort of suck it up and do the parts that aren't as much fun, or find a way
Yeah.
to get it done on a regular basis so it never becomes overwhelming. And I think that's the
Right.
worst thing for people is it gets so overwhelming. And believe it or not, every year we're working with people that haven't filed tax returns for 2 years, 3 years, and
Wow.
yeah, and it's just because of that avoidance.
And the other thing is like, since it's not right in front of you, like not doing that, because that used to be me like 5 years ago. Not doing that, the interest and penalties that you pay and the headache, like if you would have just paid an accountant or paid a bookkeeper and had a conversation with someone once a month or once a quarter or whatever, like it's the same money basically. You're either spending it all at once at the last minute, or you know, all at once at the last minute and being super stressed, or over time and like running and not being that stressed. So, um, what are some of the like? I definitely want to get into some details here. Like we were talking about let's start with like real estate sales, right? We talked about the qualify. I want to get into things that maybe people don't know that they should be doing. So, like a qualified association is one of them. Like, what do you think are some of the most common things that are missed when like people are calling you last minute? Like, hey, this is what I got. I made all this money. How am I trying to not pay taxes? And you're thinking, all right, if you would have done this, then
Right.
you would have been set up. Is a qualified association one of them, or is there other
Oh,
things that you
absolutely.
see?
For someone who's in a licensed agent or broker,
Mhm.
it's a huge way that they can save money. And it's been allowed in Pennsylvania since 2009 to form an LLC, do an S election, and have your commissions paid into that LLC. And I had somebody yesterday, this person who came in, she had done some of the things right, but she worked with someone who really didn't know what they were doing. And it's such a funky thing because the real estate commission, you have to be certified by the real estate commission,
Mhm.
and they have naming conventions, and you're not allowed to use your name or the word realty in it. Well, her company was her name, Realty Consultants. And
Oh,
so she had never even gotten it approved by the real estate commission. And she went to work at a new broker, and the broker said, show me the qualified association papers and then I'll pay the commissions there. Well, she'd never done that. She didn't know she had to. And so we see people who, from another agent maybe who has done it right, tells them they should set up an LLC, then they do it, but they don't follow through and do everything right, and then they don't get the benefit of it. And I mean, you just sort of shake your head that people are willing to spend the money to do it partway there, and then don't finish the job and get it all set up properly and use it to their advantage.
yeah. And that could
But
be like thousands every year that
oh
you're
yeah,
missing out on.
oh yeah. Well, another
Like,
great example, you referred to that. You take a salary from it, and by taking a salary, you comply with the IRS regulations. But how much salary you take can have a direct impact on how much money you save out of it. And you don't want to
mm,
be taking too much of a salary. You want to have that business entity be profitable, of itself, and not take all your money out as a salary. And so you need to. It's not hard, but it's not easy either if you don't pay attention
yeah,
to it.
right. Yeah, that was definitely the first big lesson I learned there. So, kind of continuing on that track, talking about investing for a little bit and owning properties managing rentals, and managing gains and losses. I have about 1,000, directions we could take this, but like one of the main things I've learned, I think, because I feel like a lot of people who are going to watch this are planning to invest, right? And you hear that one of the main benefits of owning real estate is, oh my God, you can take off depreciation and you can write off all these losses. I mean, ideally, you shouldn't be paying any taxes ever, like once you have enough properties. Do you think there's misconceptions about how, the actual benefits you get? Like I have more particular questions on this, but like overall with investing, like what are some of the things that people are doing wrong on that end when they come to you, besides not filing their taxes at all or not
Yeah.
claiming the income they should? Do you see any trends, or have you seen trends recently?
Well, as I said, we work with a lot of real estate agents, and one of the things that, let me, instead of talking about what some people do wrong, let me touch on a couple of things that people do right. So someone who works as a
Sure.
real estate agent can qualify as a real estate professional. And that allows them to write off losses against their other income. So if you make so much money as a real estate agent, and then you have a couple of rental properties that show a loss for tax purposes, you can offset your other income. I can't do that. I'm not a real estate professional. So if I have a rental property and it shows losses, those losses get suspended until I sell the property. And then I'll get the tax benefit of them. Not in Pennsylvania, as I mentioned before, but I'll get them for federal purposes. But someone who's a professional real estate investor or can qualify, and you have to spend enough time on real estate activities, and that includes construction, by the way. It includes property management. It's a pretty broad definition. But then they can get those tax benefits. And so as I said, we work with a lot of real estate agents. The best ones know which property to buy. And this has nothing to do with taxes, but they don't overpay for a property. They don't get a rental property that they can't rent. I live up in Yardley. It's primarily a homeowner market. And whereas certain parts of the city are much more driven by rentals, or other towns in Lower Bucks County. And these people buy the right property. They understand the market well enough so that they set themselves up for success. And they tend not to have financial investments. I think over time, as you get older, it might not make sense to have all your eggs in the real estate basket, but maybe have some financial assets and save for retirement, say through an IRA. And if there's a mistake that I see, it's some people maybe are too narrow in their focus and just do real estate. But from a rental standpoint, there are significant advantages if you buy the right property.
Right. So, by the right property, like, is that ideally a property that's maybe making a little bit of cash flow every year, but the tax benefits, that there's enough depreciation where you're actually showing a slight loss? Or that's kind of, is that like
or break even
storm, right?
And then
right.
And then you really make your return on investment 20 years later or 10 years later when you sell it, and the property's appreciated in value. And you haven't paid tax, you've owned it for that amount of time, and you haven't paid tax on it the way you might have if you had reinvested stock dividends or something like that.
Right. Because I don't know a lot about stocks. So I've only really started buying, I think maybe like in the past 18 months. But like every time, like if you buy, I don't know, $10,000 worth of stock and it goes to 20, if you're moving that money from one place to another, do you get taxed on the, like if you sell it at 20 and then go buy something?
Yeah.
And then, so you're paying gains on that, right?
Right. Yeah. I had a client this year who had a lot of taxable income from selling stocks. And I told her you had $28,000 of gains. And she says, what do you mean? I didn't take any money out of it. Well, the person who was managing her assets had sold stocks and bought other ones. Well, those were all taxable events. And so she didn't get any cash out of it, but she paid tax on it. And she said, well, I've got to talk to that person and have a discussion about that. I mean, the other advantage with real estate is it's a property and you manage it and you know what you're, you know what's going on with it.
Right. That's very interesting. I didn't know that. With that rule of stocks particularly. So, and that reminds me actually of something else I really kind of wasn't quite aware of. Like, if you own it took me a while to realize this, but like, let's say similarly with owning properties, if you buy a place for $100,000, right? And it appreciates over, I don't know, 5-10 years. If you let's say it appreciates and it's worth 300. If you refinance it and say you pull out $200,000, right? Because you pay, okay. So just to keep it simple, you bought it with almost no money down. So you say you have a almost $100,000 mortgage when you buy it. You refinance it, you pull out a lot of gains. It's tax free, right? But when you go to sell that, you're paying capital gains taxes on the full amount. Like, even if you're only walking away, if you sell it for 300 and have a $200,000 mortgage on it,
Right.
and you're walking away with whatever that difference is, you're still paying the full gains on the whole amount from when you originally bought it, right? The $200,000 difference. Is that correct?
Exactly. And actually that raises sort of an interesting question that when you ask about things that are misunderstood, how you finance a property has very little to do with how you're taxed on it. So if I buy a property for $100,000 cash and I sell it for $300,000, I'm taxed on the $200,000 gain. If I buy it and refinance it, take money out, that's not a taxable transaction. And then I sell it and I have a $200,000 loan to pay off, I'm still paying tax on the $200,000 gain, not the amount that's greater than the loan. And people don't understand that they think they're selling a property and that there's not much of a gain and they're going to pay off the loan and then have a lot of money to walk away with. Well, they may have a tax bill in addition to having that loan.
I think that's one of the things that I think a lot of people don't understand, because is when you're leveraging properties up to 75, 80% of what they're worth. Like, when you just start running the numbers, like when you finally sell it at the end of the day, you might all of the cash you're walking away with might all have to go to taxes, or nearly all of it. So
I've seen that.
That's
where people are really surprised on how the tax is calculated. And the other thing is, when you depreciate it, but basically the concept of depreciation is spreading the cost. And so if you buy a residential property, the IRS allows you to spread that cost over 27.5 years. So, simple example, if you buy a property for $275,000, you have $10,000 every year of depreciation.
right.
When you sell it, you have to recapture that depreciation. That depreciation has been used to offset other income and reduce your other income. Well, when you sell it, the IRS wants their credit for that. So when you calculate the gain, you have to take into account the fact that you've depreciated it, and you get sort of the opposite side.
So just to give a real number example, if you buy a place for 275, let's say, in round numbers, whatever, 10, 15 years, whatever it is later, say half the value has been depreciated.
Yep.
And now it's, what is it, 137.5, right?
Yep.
So you've taken a depreciation over the lifetime of owning it.
Each year.
If you sold it for the same price each year, $10,000 a year until over the lifetime. If you sell it at the same price, how much taxes would you be paying? Would you be paying a gain on
that 137?
130?
Yeah.
I didn't even know that for the longest time.
Yeah.
So it's like you're not really getting anything for free. Depreciation is awesome, but the word, I guess, is recapturing, right? Like, you're paying it back at some point. So
exactly.
I know these are pretty in-depth topics, but I'm glad we're going over some of these basic things that, if you're going to be investing in real estate, keep a couple points in mind. So I'm curious just about the actual, business end, running an accounting business. And I know you said there's a lot of real estate to it today, these days. Do you think running a business, like especially in this past year, like what do you think are just some maybe two or three things that make a business owner successful over the long term
So,
in any business?
well, a couple things. One, know what you do well, and know what your
Hmm.
customers value. And so, for example, when I meet with new clients, I'll tell them, you'll find that we're not the most expensive, and we're probably not the least expensive either. And a good client for us is somebody that has a business and has a little bit of complexity to their tax situation, and that's where we can
Hmm.
add some value. And so, if you know what you do, we're a consulting business, right? We help people comply with the law, but we more importantly help them do tax planning so that they're not surprised and they can minimize the amount of tax that they pay. And so that's what we do. And I think we do it reasonably well. And we try, like if somebody comes to me, I've had this year where we get a referral, and somebody has two W-2s and nothing else. I'll say, you can do this on TurboTax. You don't really need to pay me to do it. It's not really that complicated. And
Mhm.
and so that pertains to any business, really. If you stick to the working with the customers that you provide value for one, you'll enjoy it, they'll derive value, and they'll pay you for that value. And that doesn't matter
Right.
whether it's helping people find the right real estate investment property or help with tax work. By the way, another thing, if it's a consulting business, don't be afraid to say, I don't know the answer to that, and I'll get back to you. Be
Hmm.
right, and know your
Right.
limitations. So if you ask me about um, selling a rental property in Virginia, I can tell you the implications for Pennsylvania, but I'd probably want to go just check on something with Virginia and make sure I had it right. I would know where to go, but I know my limitations,
Right.
and I don't do that often enough, and I'd have to check on that. And so I think that's really important in any kind of a service business, is to know your limitations.
Okay. So knowing your limitations and knowing what you're good at and not good at and what your ideal client is. Do you think your challenges, like, because you guys have grown a decent amount over the past 12 years, like what's your main challenge running your business today? And has that changed a lot from a decade ago, or is it sort of the same?
Sort of at a high level, the challenges are the same. Um, I'll tell you what becomes more interesting over time is, as we've grown, we have more people working with us, and we've if I have someone working with you, they're representing me, and I want to be sure that I'm confident that that person represents me well, and not going to embarrass me.
Hmm.
And so having the right people that you can trust to talk to your clients is really important. When it's small, it was Dan and me that did all the client contact. As we've grown, there's a people dimension to the business that didn't exist before. And so
Right.
that's vital, to that people dimension. The other thing, that this has been an interesting year. Um, we all do a lot more remotely, and we've discovered that our team can work remotely really, really well. Chris, our office manager, is working from home today, and we rarely did that before. We've used technology to get um, documents more with shared folders and things like that. Um, Used to be, when we first started, people would come in, drop it off, we would scan it. People would come to the office and pick up tax returns. That doesn't
Hmm.
happen anymore. Everything happens remotely. So I think taking advantage of technology is important for any business, and not being afraid to change how you do things, to take advantage of technology, is important.
Yeah. I mean, especially in this past year, it's like the world is just like swept. I feel like evolved. It's been forced to evolve. I guess if evolve is the right word, you know, everybody being forced to work at home is like just you immediately had to just okay, we're doing it this way now.
Yeah.
Like I think one of the times we were talking a couple weeks ago, you were telling me about like figuring out like your payment processing system or whatever, and which ones you're going to use and fees and all that. Like I'm sure that's like you said, that's all of your. No one's doing anything in paper anymore.
No.
Do you see any other changes? Like, do you see any other changes to the industry or things that people should be aware of coming down the line, like in the near future, or it's really just the from physical to digital?
Well, certainly physical to digital. Um, I mean, the next step, by the way, I would anticipate by next year, we've got a way for everyone to sign off on things completely electronically. I think the real estate business is ahead of us in that, but we're learning lessons from our clients. If they can do that selling a house, we ought to be able to do that to sign off on a tax return. And again, that
Right.
applies to any business. The technology, the specific technology changes are going to be different from business to business, but the need to stay current and reactive and adapt, I think applies to any business.
Yeah. How about like accounting laws, by the way? Because I've heard lots of different. I don't follow the news too much, but I've heard a couple different like major potential changes on either tax rates, the 1031 exchange going away. Is there anything in real estate particular that you've seen that you think might actually go through? Like if the 1031 exchange goes away, um, I feel like that's kind of concerning. Like you think anything is going to be coming down the line, it's going to whack people if they're not expecting it.
Boy, it is hard to know. Um,
Hmm.
eh, and I could
I know it's a
argue this
loaded question.
a bunch of different ways, but so if you go back to the tax cuts, the big change under Trump, I guess 3 years ago, you mentioned 1031 exchange. At that time, you could do a 1031 exchange with real estate, but you could also do it with factory equipment. You could do it with cars. And that tax law took away the ability to do a 1031 exchange. So if I do have a client who has construction vehicles. When he trades in his
Right.
construction vehicle, he needs to record a gain on the sale of the one that's fully depreciated for the value he gets, and then he gets to write off the new one that he bought using accelerated depreciation. He can't do it as a 1031 exchange anymore. You can still do it with real estate. Will that change? I don't know. Um, the things that have been talked about could have major implications with changing capital gains treatment, taking away a 1031 exchange. But I have very little confidence today that Congress can agree on anything. And I think it would be really difficult to push some of this stuff through. And
Right.
so sort of sitting here today, I encourage people not to watch it, but not overreact and all of a sudden, realize all their capital gains now because the rates might go up next year. There's just way too much uncertainty with how it's going to evolve and change to overreact here in May of 2021.
Yeah. Yeah, because I've heard some people talking about that and yeah, should I sell everything this year, or are they going to backdate certain laws to, it's kind of stressful when you start staying up at night worrying about these kind of things. So
Well,
that's good to know.
on April 9th of this year, they made unemployment, the first $10,000 of unemployment for last year not taxable. April 9th, 2021,
Oh,
they changed the law to affect 2020 income. I mean, so when are we done with the year? I mean, it's crazy. You would think that
wow.
for the law governing 2021 that you would have to pass it in 2020 so people could comply with it and adapt to it and use it to their advantage. But clearly that's not the case. There are many examples of tax laws being passed late in the year and even, especially this year, even after the year ended. The taxability of the payroll protection programs changed changed late in the year. Last year,
Oh,
when the CARES Act passed, it was not taxable. Then the IRS issued a ruling saying it was taxable for federal purposes. And then Congress clarified it in late December and said it wasn't taxable. That's just an example of the uncertainty that we've had to deal with in the last year.
Wow. Well, I'm glad that it's not taxable.
Yeah.
But who knows if it's going to change again?
You don't know.
Right.
You don't know. Yeah.
Yeah.
And to your question about 1031 exchanges and capital gains, very hard to predict where it's going to end up.
Right. Okay. Is there anything else before I ask my last question? Anything else that I should be asking that you think people should know, either about accounting or the landscape or what's going on today?
Well, one of my favorite things is don't let tax law drive all your business decisions. Make solid business decisions first. And that includes investing in real estate. So if you're going to do a flip, buy a property that you can make money on and renovate it in a way that you can make money on it. Don't do it just for the tax benefit. The tax benefit or the cost of it, if you make a lot of money, you're going to pay some tax on it, and just recognize that. Be aware of the laws, but don't do things solely for tax purposes. Do them because they're good for your business, whether it's real estate or whether it's something else.
Right. Like, don't buy a rental property that's going to lose money every year because you're going to save on taxes.
Right. Right.
As insane as that sounds, I've seen it done. I'll only just lose $100, $100 a month or whatever. No big deal. Like, I can handle it. Like, oh, so
it's hard enough
awesome.
to make money. You wouldn't want to plan on not making money. That's kind of my stuff on that.
Well, sometimes people speculate, oh, well, the area is appreciating a lot. I think in 5 years, I'm going to be able to sell it for like $100,000 more. So I don't mind losing on it now, but that's a very dangerous, it's a dangerous proposition. Same when people over leveraging on houses that, oh, the bank told me I could buy a $770,000 house because interest rates are really low. And you know what? I was only going to look at like 450, but why not? Yeah. So I've seen that several times. Plenty of stories about that. But so where can people find you if they want to get in touch?
So I always tell people call me directly. Call my cell 215-920-2301 or email. And it's my name pclough at our company name Fresnel Partners.com.
Awesome.
And
we'll
probably the other thing to add there, Rodney, is I'll talk to anybody, and first conversation is a get to know you and get to know the situation, and if I can get a better idea whether I might be able to help or provide some advice, and so then we'll figure out from there whether I'm the right person to do that or not. But I'm always happy to talk to somebody on an initial conversation.
Cool. I'm sure there's going to be hopefully more than a few people that are going to watch this and realize, I need to get my life together. And my situation is just complicated enough that I think that he could help. Like, it's like you said before, like if it's super simple, then they can use TurboTax or do it themselves. But once you start investing a little bit and really getting a little bit more of a plan that has several moving parts, then you really need to start. You need to have someone on your side who knows what you're doing and how you should plan.
Well, and that's a great point, because we see things sometimes after the fact, and you shake your head, and if people they're making big investment decisions for them on whatever scale it is for them, and if they'd asked first, they might have been able to do it differently and save some money. And so I always encourage people to ask the question. Maybe the answer is exactly what you thought it was, but at least confirm that, and ask when there's money involved on significant transactions in your life. Know ahead of time what the implications going to be.
Absolutely. Like I've regretted a couple of times not asking. Like when especially when we're talking about, you know, the selling gains, refinancing, like even just timing your sales sometimes, like, oh,
Yeah.
I should sell a property this year, so I'm not claiming a huge loss, which is going to hurt my tax return and prevent me from qualifying for a loan. Like those types of conversations,
Right.
I think need to be had.
Yeah.
So, because it's always a funny balance between showing enough income, well, in real estate particularly, showing enough income so that you can qualify for the loans you need to, so you can keep your business going,
Right.
and not paying extravagant amounts in taxes. And
Yeah.
it's not as simple as it seems once you're above the basic, like I own a house and that's it. So,
Right.
yeah. Awesome. Well, I definitely enjoyed this conversation. Thank you again for joining me. And I hope a lot of people get a lot of value out of this. I look forward to doing this again soon. Hopefully when we're further on and have even more in-depth questions to ask, maybe when we're bigger in a couple of years.
Sounds great. Enjoy the conversation.
Awesome. All right. I'll talk to you later.
Take care.